fundamentals of accounting, we should know about the business and what business actually are and how it works and how it generates profits for a businessman. We should know each and everything about business. So business is a commercial, professional or industrial activity driven by an individual or a group of individuals engaging in producing and selling goods and services for profit is known as business. For example, proprietorship, partnership, limited liability partnership, private limited company, public limited company, all these are considered as profit organizations or a business. But the cooperative societies and NGOs are the non-profit organizations that whose main objective is to provide welfare of the society, and the secondary objective is to earn the profit. Next, we will discuss types of business sector. So here the first type of business sector is producing raw material. If we want to produce the finished product, so first of all we need a raw material. So these are the business sectors which are involved in the production and extraction of the raw material. Next is trading. The business of buying and selling commodities and products between the seller and the buyer is known as trading. Third is manufacturing. The process of converting raw material, components or parts into finished goods that meet a customer's expectation is known as manufacturing. Next is service. An enterprises of professional or team of experts that deliver work or aid in completing tasks for the benefit of its customer. A type of economic activity that is intangible. Examples of a service business are consultancy and professional services rendered by chartered accountants, tax consultants, doctors, engineers, recreation, healthcare and transportation, etc. Next is, now we will discuss the meaning of accounts before proceeding with TelePrime technical accounting software. We should know about the accounting, what is the process of accounting. So accounting is the practice of maintaining precise records of the financial dealings of a business. It involves identifying business transactions, recording them and summarizing the same in such a way that important financial information can be communicated to the stakeholders of the business. Accounting is also called the language of the business and finance. So there are some common stakeholders of a typical business concern who actually deals with the business, and before dealing with the business, they should know about the business financial position and the business annual profits. So now I will tell you some of the external and internal stakeholders of the typical business concern. Number one, the internal stakeholder, owner. The stakeholders are the owners of an organization. Number second, employees. These people are employed for wages and salaries. Third is investors. These investors can be owners or outside vendors who typically have a right to know the accurate and timely information such as regular financial statements. Next is supplier. These are the people or businesses who sell goods to your business and rely on you for revenue from the sale of those goods. Next is customer. These are the people who business profits. Actually, when the customer buys the product and service from the seller, so they are actually releasing the business products, and they are actually making the business of the seller. Communities. These are stakeholders which are considered as business function by another set of stakeholders like suppliers, customers, employees. Now we will discuss the meaning of accounts. Account is a process of identifying, systematic recording, summarizing, analyzing and interpretation of financial reports of a business. Next is, there are some phases of the accounting cycle that I am going to discuss with you. So there are 7 phases of the accounting cycle that is to be performed under manual accounting. But when we talk about computerized accounting, so only out of 7, only 2 activities we have to perform. So first one is understanding the transaction. It is very important to understand the transaction before pass the journal entry regarding that transaction in the journal books of accounts. So the details of transaction like date, debit and credit amount, etc. is to be understandable from the transaction, like what kind of, when the transaction happens, what kind of debit and credit accounts are involved in the transaction. We should understand all these things. Next is journal entry. In this process, we will record the business transaction by debiting and crediting the different accounts. Next is ledger posting. In this process, we will transfer the transactions which were recorded in the journal to its corresponding ledger accounts. Next is trial balance. In this process, we will determine the list of all the journal ledger accounts into debit and credit account column totals that are equally contained in the ledger of a business. The purpose of producing a trial balance is to ensure the entries in the company's books of accounts are mathematically correct. Fifth activity is profit and loss account. After maintaining trial balance, we have to prepare a profit and loss account. So in this process, we will determine the net profit and loss of a business that occurs during the accounting period. And at the end, the activity which we performed is balance sheet. In this process, we will determine the summary of the financial balances of a business or an organization. Now they have given me one important note to be remembered all the time. So the note is, in the case of manual accounting, all 7 activities are carried out manually by accountants. But in case of computerized accounting, that is when we are going to do the accounting through Tally software, out of these above 7 activities, only 2 activities are performed manually. For example, those activities are understanding the transaction and passing the voucher entry. Alright. Next, there are some accounting terminologies that we should understand and that are commonly used in the business are. Number 1 is capital. The amount of money or money worth introduced into the business by owner is called capital. So whatever investment is being made by the owner of the business, that amount of investment is known as capital. Whether your business is in large scale, whether your business is in small scale, or whether your business is in medium scale, you need to invest some kind of amount in your business before starting the business. So that amount of money is known as capital. Next is transaction. So transaction is a business activity that involves the transfer of money or money's worth between two accounts, and it can be of two types: cash transaction and credit transaction. Cash transaction is one where the money is immediately received or paid in the form of cash, and credit transaction is the one where the money is paid later but the benefits are enjoyed immediately. Next is assets. So these are those capital assets that is once purchased by the individual or company, the ownership and legal possession gets transferred from seller to the buyer. Then the expenditure on such assets are of non-recurring in nature, that is only after a specific period we usually do expenditure on such capital goods. These are those assets that generate profit for the business for more than 1 year in the business. There are two types of assets: fixed assets, that is a tangible fixed asset, and second point is intangible fixed asset. So here tangible means that those fixed assets that to whom we can touch, see and measure in terms of money. And intangible fixed assets are those assets to whom we cannot touch, we cannot see, but we can measure the value in terms of money. And the second type of asset is current asset. So the current assets are those assets that generate profit for the business for less than 1 year in the business. For example, cash in hand, cash at bank, sundry debtors, bill receivable, etc. Next point is liability. So whatever, like suppose you have taken some amount of funds from your friend, from your relative, or from any other party. So it means it's obvious that if you have taken some funds from anybody, you have to repay those funds back to the party. Alright. So like unless and until you didn't pay the funds, unless and until you will not, if you will not pay the funds back to the party, then in that case your liability will get arise, and your liability will exist against that party. So whatever the entity owes to outsiders, so it includes loans, the amount payable to creditors, etc. For example, you have purchased some goods from a specific party on credit. So it means that you have taken the goods and you are enjoying the benefits of goods, but you have not yet paid the amount to that specific party. Then that specific party will be considered as sundry creditors for you. For example, bills payable, sundry creditors, outstanding expenses, income received in advance, etc. Next is drawings. Money or money's worth which is withdrawn by an individual or corporation from a business for his personal use. So whatever you are withdrawing from the business, whether it is a cash, it is a goods, it is a fixed asset. If you are withdrawing all these things from the business for personal purpose, then that withdrawal will be considered as drawings. But there is an important note they have given to me. If withdrawal of any specific things in cash or in kind for official purpose, it shall not be considered under drawing. Alright? Because you are withdrawing some amount of cash for utilizing that cash for business purpose only. Alright? Next is bad debts. When a debtor becomes insolvent, the trader will not be able to realize in part or full amount due from the customer. Part or full amount will remain unrealized. The unrealized amount is called bad debts. Bad debts are irrecoverable receivables sometimes. So sometimes you get the delayed payments, you recover the delayed payments, or sometimes your delayed payments becomes defaulter. Alright. Next is purchases. A purchase is the number of goods bought by a business for the use or for reselling. So either you are purchasing the good for your self-consumption, or either you are using the good for reselling purpose. It will be considered as purchase. So purchase are of two types, cash purchase and credit purchase. Goods purchased with immediate payment of cash are called cash purchase, and goods purchased on credit are called credit purchase. Next is purchase return. So if in this case, if you have purchased some goods worth rupees 70,000, and from that 70,000 goods, while using the product, you suddenly saw that there is a kind of defectiveness, and some amount of goods are in poor quality, and their quality is not up to the mark, and their quality is very inferior. So in that case, the goods that have been purchased but are returned to the seller before consumption due to reasons like poor quality and damage are called purchase return. Next is sales. Sales refers to the number of goods sold by business. There are of two types, cash sales and credit sales. Sales made against immediate payment of cash are called cash sales, and credit sales, sales on credit, are called credit sales. Next is sales return. The goods that are sold but returned by the buyer before consumption due to poor quality and damage are called sales return. Next is debtor. A debtor is a person who receives benefits from the business immediately but is obligated to pay for the same in future. Alright. So debtor is a person to whom we have sold the goods, and he has taken the benefit of those goods, but we have not received any kind of amount from that sundry debtor. So it means that he is enjoying the benefit of the goods in present, but he will make the payment in coming future. Alright. Next is creditor. So creditor is a person from whom we purchase the goods and services on credit basis. So it means that we are enjoying the benefit of goods and services in advance, but we will make the payment in future to that creditor. Alright. Next is stock. Unsold goods, raw material, etc. that lie with the business are collectively known as stock. So whether the stock is of finished good, whether the stock is of raw material, whether the stock is of unsold goods. So the goods that are unsold, the raw material that is unsold, that collectively lie in the business godown is known as stock. Then revenue. The earnings of a business through its business activities and operations is called revenue. Next, there are some concepts of accounting. Number one is business entity concept. So business entity concept states that the business will be considered as a separate and a distinct entity from its owner. So that means that the recognition of the business is different and the recognition of the businessman is different. We can't combine both together. Alright? We can't recognize the business from its owner and we can't recognize owner from his business. Alright, so the recognition of the identity of the business is different and the identity of the businessman is different. So that's why while recording the books of accounts, we always consider quantitative transactions, that is only business transactions. We never consider personal transactions in the books of accounts. So there are some types of business entities. Those are sole proprietorship, partnership, private limited company, public limited company, corporation, and limited liability partnership. So these are the types of businesses that always consider business entity concept. Next, going concern concept states that when we are going to start any kind of business, so we always assume that my business will go for a longer period of time. But in real life, it doesn't happen like this. So in assumption, it is 99% chances that my business will go for a longer period of time. But only 1% chances are the negative chances that my business will get shut down. Alright? Next, money measurement concept. So money measurement concept states that only those transactions that can be measured in terms of money will be recorded in books of accounts. We can't record qualitative features of any employee or any qualitative features of any transactions in the books of accounts. Next is cost concept. The cost concept is also known as historical cost concept. So this concept states that the assets which are acquired by a concern are recorded in the books of accounts at only cost price. The cost of acquisition is related to the past, hence it is known as historical cost concept. So this concept states that the asset, the specific asset which we have acquired on a market price, only the market price will be considered while recording the fixed assets in financial statements. I will not consider only the book value will be considered. I will not consider market value of the asset. Dual aspect concept. This concept states that every financial transaction has twofold effects. One aspect is when the businessman is providing benefit to the party, and the second aspect is when the business is receiving the benefit from a specific party. So while recording the financial transactions in the books of accounts, we always have to follow twofold aspects, debit aspect and the credit aspect. Next is accounting period concept. The accounting period concept can also be called as periodicity concept. Life of a business is indefinite. We already know that life of a business and our life is uncertain. At any time the uncertainties can happen in the business. We don't ever know that at what time the uncertainties will happen. So that's why thus indefinite period is divided into periodic intervals, and each interval is known as accounting period. And at the end of each accounting period, financial statements like balance sheet and profit and loss accounts are prepared to know that financial position of the business. Next is revenue realization concept. This concept states that the revenue is considered as a earned income on the date when it is received. As per this concept, unearned or unrealized revenue will not be considered. This concept is very vital for determining income pertaining to an accounting period. It reduces the possibilities of inflating incomes and profits. Next slide is accrual concept. This concept requires that income and expenditure, while preparing income and expenditure, we only need to consider receivables and payables instead of receipts and payments. Receivable means the amount which is not yet received but will be received later.